Hey everyone, welcome back to Upside Down Data. Today I want to talk about the carnage we've been seeing with Bitcoin and the broader crypto markets, some of the macro factors that are likely contributing to this, and where we might be heading next. So if we just look at Bitcoin, what we can see with the benefit of hindsight is that this looks like a pretty textbook rejection off of the 200-week moving average and the 50-week moving average, which both converge at around 25K. We have now capitulated quite far off of that. We have come quite a bit down off of those levels, kind of roughly 20% off those levels. And now we're actually trying to find support at around the 20-week moving average. So we'll have to watch and see if that can hold. Now, when we think about things that are leading into this or contributing, one of the big ones, of course, is Silvergate Bank collapsing and basically going bankrupt. So the stock, is falling off a cliff, and then they more recently, announced that they're going to be shutting down. So it is now, dead in the water. And of course, Silvergate provided a lot of banking services to crypto companies, crypto exchanges, and other companies as well. So basically, the loss of this, or the collapse of this bank, has gotten a lot of people scared. And I think that's been partly why we've been seeing all this weakness in the crypto markets. That this collapse is something that kind of is a holdover, something that the FTX collapse really kind of led into, most likely. And then now we're seeing this play out even more contagion from that event, dragging prices down. Now, Silvergate's not the only bank that's in trouble, though. We also have Silicon Valley Bank, which is down 60% today. They actually paused trading on this today, so that's why this isn't updating currently as I record this. But absolutely brutal. Now, it's not clear yet if Silicon Valley Bank is going to go under. It should be noted that Silicon Valley Bank is not a crypto bank. It's not really involved with that. It's more involved with tech and venture capital and things like that. But what we're seeing in a more broad sense is banks starting to fail. And that has a lot of people worried because that reminds them of 2008, 2008, Bear Stearns collapsing, Lehman Brothers collapsing, which then was kind of the canary in the coal mine that led into the big catastrophe and complete bloodbath that we saw in the economy and in markets. And so if we look at what the stock market's doing right now, so the S&P 500, for example, you can see that we had come down to this kind of trend line that a lot of people have been watching throughout the bear market that we had broken above, and a lot of people got really excited, but now we've broken back down below it, and it's possible that more pain is in store. And one of the things that can be useful is just go back and look at history and see, what happens with these trend lines. And oftentimes I think people get way too overexcited with them, because you can imagine that back in 2007, 2008, a lot of people were probably looking at this kind of a trend line and saying, oh, look, we broke above it. That's great. That's bullish, only for us to collapse back below it and, go down to the ultimate bottom, way below. Or even in 2000, a similar story could have been told. We're like, look, here's this descending trend line. We broke above it. But then, of course, the actual bottom was still not in yet. And so, I'm not saying that has to happen again. Obviously, nothing has to happen at all. But there's precedent. And so really with these kind of trend lines, I think they're things that are interesting to watch, but you shouldn't see them as any guarantee by any means if we're breaking above or breaking below or getting to them, etc. They're just something that's kind of one more data point to look at, but certainly not something you should be seeing as like the end-all be-all of what's going to happen in the market. And so for us to have further downside, it is plausible. And especially in this environment where we're seeing banks starting to fail, while the Fed is saying they're going to get even more hawkish, that they're going to accelerate the rate of interest rate hikes, that they might hike by 50 basis points instead of 25 at the upcoming meeting, all in the face of this weakness that we're seeing in the banking sector already, at least with some banks. That probably has a lot of people concerned, and that's probably part of what's leading into all this weakness here. So that's something that's notable. And one of the other things that's also important to note is that this is all happening in a context where we've had leading indicators of recessions screaming that a recession is probably in the cards in the not too distant future. I'm showing you here the spread between the 10-year Treasury yield and the 3-month Treasury yield, which is a quite reliable predictor of recessions, a leading indicator of recessions. So TradingView only has data back to the 90s, but you can see here it inverted in 2000, inverted before the 2008 crash, inverted before the March 2020 recession, though that was short-lived. There was still a recession then. And then now it is massively inverted. It's actually the most inverted that is on this chart. And inversion just basically means when the short end yield is higher than the long end yield, that tends to be a heralding of a recession, because that's the bond market not functioning the way that you would expect. Generally speaking, yield of shorter duration treasuries should be lower than yield of longer duration treasuries because you have more risk when you buy longer duration. When you get inversions, that means that there are things going wrong, and oftentimes that can lead into recessions. And so really with this kind of, all of this kind of going together, I think the fear in the market of something really catastrophic happening is quite high. And, I'm not sure if people trust the Fed to be able to navigate that well. I mean, certainly it seems right now the Fed is more concerned about just making sure inflation's dead, that, they want to see, they've basically said they want to see unemployment come up. Essentially, they want to see a recession happen. And I think the question is, can they stop any kind of recession from being a really nasty recession or not? I don't know if a lot of people have faith in that. We'll have to wait and see. But it seems like this time would have to be quite different for us not to get a recession based on some of these leading indicators. So that's kind of the macro backdrop. There's a lot of fear that we're seeing from a lot of this weakness in the banking sector, all in this context of hiking interest rates and, leading indicators of recessions. And also we saw this in the crypto market as well leading into this. So in a recent video, one of the things I had mentioned was that the trend confidence indicator, or TCI, which really is trying to give a sense of how confident we should be in the current trend, it had flipped basically entirely red across all these assets we follow. It had flipped into the red a while ago. So if we just go back and look at the Bitcoin trend confidence indicator, for example, we can go ahead and scroll back over here. It flipped down to below zero. All the way back here is when it flipped negative. And then, basically it was saying at that point that as we went further and further off that point, the likelihood of this uptrend continuing was getting less and less likely. And that's exactly what we've seen. So there were some early warning signs that we saw from some of our trend models just here. And I mentioned this in a previous video. There's a lot of weakness. This turned red a while ago, and that was concerning. It was something I was watching, that this is not a kind of thing you want to see for an uptrend to be able to continue. Indeed, that ended up playing out. And now that's also bled over the MDC, the market direction classifier. So this model basically has a critical level that if you're above it, that's bullish. If you're below it, that's bearish. And we've seen almost universally, except for just a couple assets, us falling below those critical levels, which would suggest that, if history is any guide, when you do this, that can often lead to some notable downside. So, if we don't want to see further downside, we'd like to reclaim these levels as soon as possible, but I'm not super optimistic that's coming immediately. I think short-term bearishness is more what these data are pointing towards. Now, the one counterexample to that, to some degree, is that if we look at the short-term UDPIs, I'm showing you the short-term UDPI for Bitcoin here, we can see we have fallen down quite a bit so far. We've come all the way up here to around 1.7 or 0.07, so pretty high, pretty overextended, actually similar levels to what happened back here in April of 2022. We got rejected off that level, we've come back down, but we're not necessarily at the similar levels that we've seen kind of local bottoms form more recently. So we probably want to see something more in the negative 3.5, negative 4, somewhere around there, before we might think of that being as a more definitive local bottom if this downside momentum continues. But we are, I think it is safe to say that we are getting more and more oversold, to the downside. We just see right now that the short-term UDPI is negative, and for a lot of these assets in the deep negatives, where this wasn't the case not too long ago. Not too long ago, the majority of short-term UDPIs were actually in the positive range, getting in the overheated zones. But the reason why I'm not thinking this means we're going to find a local bottom and just rally immediately off of that is that if we just look at the context of what's going on with our longer-term risk indicator, longer-term UDPIs, which care about moves that play out over multiple months. And again, I should mention, if you're not familiar with these models, these are risk indicators. So higher levels are higher risk, lower levels are lower risk. You can see that the long-term UDPI for Bitcoin and for another number of other assets is still quite high relative to where it was not too long ago, before this big rally ended up happening. We're currently at, round about negative 0.8, so not too far. There's a lot of room to the downside to go, basically. So the model, even though there is slightly more realistic upside and downside potential in the longer term from the model's perspective, there's still plenty to the downside. And this being, a bear market until proven otherwise, us going down and eating into this downside seems very possible here. And what we might end up needing to see is the long-term UDPIs across the board cool off quite a bit more before we can be more confident of a more kind of definitive, longer-term at least local bottom before we can start moving back to the upside. And so you're probably going to see the short-term UDPI kind of be volatile. We'll probably find some kind of more localized local bottoms where we kind of bounce up off of that level. But then to be more confident that we're kind of hitting at a more inflection point to maybe push things back to the upside, I'd really like to see the long-term UDPI cool off a bit more. Doesn't mean that has to happen, right? Anything's possible. We could, reverse tomorrow and go off to the upside. But that's not currently my base case. And so really what we're just seeing here, is a lot of pain. Now, the final thing I wanted to mention in this video is that I've seen some people say that with this weakness in the banking sector, that might force the Fed's hand to not only slow down, but maybe even pause or actually even start cutting interest rates. And then people say that, if that happens, time to get massively bullish and, go all in, all that kind of thing. I just wanted to point out once again the potential problem with that line of reasoning, because I think a lot of people have this mental model right now that if the Fed starts cutting interest rates, then that is going to be rocket fuel for risk assets and that everything's just going to go to the moon. I think there's some caution we need to have with that narrative, and I'm going to point back to historical data to talk about it. So this orange line here is the Fed funds rate. That's just basically the interest rate set by the Fed. This is the one that they raise or lower. And what we'll notice is that in points where we get actual reversals, we actually get cutting of interest rates after a hiking cycle. Look what happens to the stock market after that. So this is the S&P 500. The Fed started cutting interest rates all the way back here in November 2000. Look at how far the stock market then fell until it found an actual bottom. Basically, cutting interest rates did not help risk assets. Actually, risk assets collapsed well beyond that. Same thing here, 2006, 2007, going to 2008. Cut interest rates all the way back here. The whole bear market then played out after that happened. Same thing actually even happened here. We had this rate hiking cycle that then got reversed, but the big collapse didn't happen until later. Now, you could argue this is a black swan. This wouldn't have happened in normal circumstances, but, regardless, it is just one more data point. But just looking at these then, what it might suggest is that maybe a pause can be short-term bullish, because you do see that there can be some upside that comes, once the pause happens, once interest rates aren't hiked anymore. But when the cutting happens, that can be actually precede some pretty nasty drops. And one of the reasons for this, or one of the arguments you could put forward for why this might happen, is that the Fed is reactive oftentimes with their policy. And so when they start cutting rates, there's oftentimes a reason for why they're doing so. And essentially it could be that their hiking cycle or something else in the economy has gotten so broken that they think that they really need to start easing monetary policy because they know that something bad is about to happen, that things are going to start getting bloody. And so then when they do that, then whatever was going to play out just ends up playing out and tanks the stock market. So now, obviously some people would argue that this cycle might have been different and that a lot of the pain we're going to see in the stock market already played out. And so this time when the Fed starts cutting rates, then, the recession or whatever would already been priced in. We can move up. Who knows? But I do just want to point this out as a point of caution, that when you see that narrative, just know that it has not actually played out that way in the past. And so this time would be different if a rate cut would, at least different in recent history, would be different if rate cuts just led to a big rally. Now this time could be different, but it's just something to keep in mind, that this is not something that we have a lot of historical precedent, at least in the recent past. So to wrap us up then, I do think that things are looking pretty bleak in the crypto market. Now, do I think that means we go straight to new lows? No, not necessarily. I think there's actually a reasonable possibility we could maybe turn this lower level into support down here, and then, maybe go back down into this level also. I think all of that could play out depending on what happens in broader markets. Now, if broader markets completely collapse, then I think we are heading to new lows quite likely. I just think it's unlikely that Bitcoin can hold the November lows if the stock market's falling off a cliff. I just don't think that's going to happen. But, if things don't get as bleak in the macro picture as, people think, I think what we might end up seeing with Bitcoin is maybe something more like we saw in 2015. And, a lot of people were saying that we're going to be going into a 2019 type of situation. I made some videos comparing and talking about the possibility of that. But one of the things that I've also talked about in the past is how I, kind of saw this bear market we've been in as probably likely to play out more similar to what we saw in 2015. Now, obviously, everything's going to be different, so it's not going to be exactly the same. But in 2015, what you see is that we got these multiple times, we got these big rallies that probably got people pretty excited. You know, back here, you know, these were some massive rallies. You know, that one was 40%. We go all the way from the low, you know, it was up, you know, 80%, you know, kind of a rally from the bottom. And then we had these big collapses also. And so I think that that kind of thing playing out again would not be completely unreasonable. And I think that we go back and retest these lows again, totally feasible. Very well could happen before we can maybe actually start the big push up into a new bull market. So those are just some things that I'm watching. Obviously, none of this is intended to be financial advice. You know, you should make your own opinions from your own conclusions from the data. Just some things that I wanted to point out. So if you want to take a look at our data, you can go over to claritydigital.io, the site that we've launched in collaboration with Jay over at Daily Crypto Analysis. Take a look for all these data for yourself and keep an eye on them in real time. All right, if you like the content, remember to subscribe to the channel, give the video a like and follow us on Twitter. Go check out claritydigital.io to keep an eye on the data.